In this video, we're going to be taking a look at ticker symbol GNUS, and I'm going to be doing a complete breakdown to find out whether or not this stock is a buy. And we're going to be starting right now. What is going on? It's Pat from Top Ticker Trades. If this is your first time here and you want to learn about investing and trading in the stock market, make sure you start now by subscribing and tapping that bell so you never miss a thing. I'll see you guys in the video. What's up and welcome back everybody to another video. So today's video is on GNUS Brands International Incorporated, or ticker symbol GNUS. Okay, they are a content and brand management company which engages in developing, producing, marketing, and licensing branded children's entertainment properties and consumer products for media distribution and retail channels. They act as a licensing agent for certain brands such as Llama Llama, Psycho Bunny, From Frank, and Celescence Technologies. So the company was founded by Balaban Howard Allen on January the 2nd, 2006, and is headquartered in Beverly Hills, California. So this stock has had some major moves lately, as I'm sure everyone is aware. It was previously trading for just 31 cents per share back in May, which was last month, and now we've seen as much as $12 from this stock last week. So now obviously this company has had a lot going on for it right now, and obviously a lot of positive catalysts were recently announced to drive the share price from where it was in May at just 31 cents to where we recently saw it at $12. So the question that we will want to answer here is, what are the catalysts that drove the share price from 31 cents all the way up to $12? Because last Wednesday, we saw that shares pretty much doubled in value. So this was also the fourth day of sizable gains for the company stock. On Monday, and this is all last week, Monday, we saw it up by 28%. Tuesday, up by 53%. Wednesday, up by 97%, closing at nearly $8. Thursday is when we hit $12. Now, I am aware that we didn't hold all of these gains and we're back, in the mid $5 range. And we're going to get to talking about that shortly. But first, let's take a look at why GNUS shares ran up like that. So some of the catalysts that GNUS investors are obviously crazy about are, the announcement of a new toy line and the launch of a cartoon channel, or a cartoon channel offering, rather. Now, other properties of the company are Rainbow Rangers, Warren Buffett's Secret Millionaires Club, and Llama Llama, which I think we already mentioned. The cartoon channel is set to launch on June 15th, and the company announced some significant hires, which, number one, Margaret Loesch, if I'm pronouncing that correctly, she's going to be the founding president and chief. She was the chief executive of Fox Kids networks worldwide. Then number two, they announced David Newman, which is going to be the chief content officer, who has previously worked for Disney and NBC. So towards the end of last week is when the company announced that these two significant new hires were going to be running the cartoon channel. Okay. But the share price fell around 3.5% on Thursday last week, and then Friday continued to drop and fell 9.9%. And some of you may, be a little bit shaken up by the drops, but you got to realize we're at over 1,000%, nearly 2,000% gains in just a month. It was actually 1,861% gains for the month. So this should definitely be taken into consideration before anybody freaks out about any type of small drops. And in saying that, I do realize that, the drops occurred on release or announcement of good news. okay? But there are definitely, catalysts which were probably responsible or likely responsible for the drop in share price, just as well as there were catalysts that caused the share price to go up. So let's take a look at the negative catalysts, okay? Number one, anytime you have a run up like that, especially, that big of a gain or that much of a run up in such a short period of time, you're going to have people that are, I guess, uncomfortable with holding. So what they will do is take their profits, and this is normal and it's healthy. I mean, this was a huge move we're talking about, and a 4-day streak that needed a healthy pullback. It was just necessary and equally due. But there's also another reason, and I believe this is going to be the major catalyst behind any kind of drops in shareholder value, and that reason is Hindenburg research. On June 5th, Hindenburg published an article titled "A Bag Holder's Guide to Why We Think GNUS Brands Will Be a $1.50 Stock Within a Month." Now, I've previously brought up Hindenburg research in another video I've done, as they were the reason behind the drops in share value of a company I was reporting on. And I'm sure a lot of my listeners are familiar with Hindenburg research, but I'm also pretty sure that a lot of you guys, especially the new ones, are not. So, for those of you who aren't familiar with Hindenburg research, it is a company that claims to specialize in forensic financial research, and they claim that they rely on fundamentals and hard to uncover information from atypical sources, okay? So here's what I have to say about Hindenburg. And before I tell you that or get into that, let me just say that a video on Hindenburg is long overdue on my part, so you will see one coming. I think this is going to be, pretty much necessary at this point. But for now, I'm just going to give you a couple of details to give you an idea. So Hindenburg seems to mainly consist of a guy named Nate Anderson. I'm not able to find anyone else associated with the company in terms of being employed by the company. And Hindenburg is infamous for taking short positions on companies and then releasing or dropping articles that portray the company in a negative light. And, it always sucks to see somebody drop a negative article or, bad news on a company that you are holding a position on, investing in, whatever the case may be. But, I certainly would appreciate this kind of information and appreciate these type of articles if I believed that, they were genuine and if I trusted the source. The good news here for those of you that are investing in this company or plan on investing in the company, I do not look at Hindenburg as a credible source here. In fact, in my opinion, anything that comes from them is the opposite of credible. From my experience, and from what I've been able to dig up, the information reported by Hindenburg in most cases has either been highly over-exaggerated, false, or simply just rumors that lack any type of substantial, evidence or any facts to back these rumors up. So in other words, what I would classify Hindenburg as is, a company that posts articles containing fruitless allegations. Now, I have been able to dig up some court documents naming a Nate Anderson, who is also the founder of Hindenburg, in lawsuits over reporting false information. Unfortunately, most of these have not yet been settled or ruled on. So that kind of, I'm waiting on that before I can actually, go and say more. However, and I know I told you guys I would be making a video about Hindenburg. Well, I'm also going to be making a separate video going over all of the entire Hindenburg research article on GNUS brands, and I'm going to try to have this out as soon as I possibly can. But what I would suggest for now is that if you have done your due diligence on GNUS brands and you're comfortable with what you see here, then don't dump your shares based on a Hindenburg research article. Okay, you should apply this to any position that you're holding and not just GNUS shares. You should rely on yourself and not anybody else, especially in this case where from what I'm seeing and from what I've learned, Hindenburg does not seem to be a credible source for information, especially since they have an interest in the value of the share price going down. I mean, essentially, if you look at it, it makes sense. Hindenburg, or Nate Anderson, stands to profit quite a bit if GNUS shares fall. Now, another pattern that I've noticed with Hindenburg is that they wait until a stock's share value is overextended a little bit. You know, they wait till some positive catalysts are revealed and the stock runs up. And they like to do this on stocks that have, you know, massive run-ups, kind of like we just saw in GNUS brands. And then they strike because they're already expecting that investors are going to be simply taking profits. Now, I realize there's a lot of you that are, you know, long on this company, but what I need you guys to realize is that there's a lot of people that are, you know, swing trading, even day trading. So everyone that's swing trading will be taking profits, you know, as the stock runs up and then looking for a new re-entry point possibly to do it again. And they're trading based off of technicals. Then you've got your people that are holding long, but sometimes if the stock runs up too fast, like we just saw GNUS do, you know, they're gonna, you know, be looking to take profits possibly and for a re-entry point on a pullback, because anytime you see such a large run up, you're expecting, you know, that there will be a drop. So this is what Hindenburg banks on, and they take advantage of this knowledge, which is pretty much common knowledge, and they strike at the right time, and it causes a domino effect because it'll also take out all the weak hands and, you know, new people that are in on this stock that don't know any better, and the share price just comes tumbling down, you know. So I guess the bottom line here is to do your own due diligence, and for now, do not sweat the Hindenburg article if this is something you've seen and you're worried about. Okay, I'm gonna report further on this, like I said, but for now, let's move on to a different topic. So we've already established that short sellers are potentially behind the decline in price. We actually just finished talking about Hindenburg, and now allow me to introduce you to yet another short seller that wants a piece of the action. And that short seller would be no other than Citron. Citron Research is widely known as a short selling research firm, and on June 4th, we saw some tweets from Citron calling GNUS brands a joke and referring to them as child's play. So really, there's no doubt in my mind that the shorts here are playing a massive role in the drop in share value, but there is also another reason, and to me, this is going to be the one that seems to be the most concerning. So there are 60.1 million common shares being released into the market. Okay, there's two components of this, or to this. Number one, there's 31.1 million common shares, and number two, 29 million shares that can be issued if outstanding warrants are exercised at an average price of 21 cents per share. Okay, 21 cents per share. And the warrants were issued to accredited investors in a private placement on March 17th. All right, so this brings up a whole new set of concerns for me. So let me just say, I do like this company and see some potential here, but this is in fact very, very concerning to me. And I would like to have some answers from the management team before putting any of my own money into it. Okay, I want to know who these investors in a private placement, as they're called, actually are, and how they came to be so lucky or special to get 21-cent shares, while the rest of the retail investors, are paying whatever the share price currently is. Like what right now, $5 and something cents. So also the timing of the announcement of these warrants is another concern. It's very concerning to me and raises even more questions. Okay, it seems that the company is not too concerned about its shareholders and retail investors, or at least not as concerned as you would expect them to be. It seems that diluting shares has been a common practice in the past, and from what's going on now, it's the same situation. Nothing's really changed. What I would actually expect to see in a company that values its retail investors and is growing at a healthy pace is maybe an announcement of some share buybacks instead of dilution. And what I'm seeing here, and how I would personally interpret what I am seeing with the share dilution, and especially within the time frame that the share dilution was recently announced, and being followed up by positive news, is that the company believes that the shares are not worth the amount that they are currently trading at. So I'm going to be assuming that the stock is going through a pump and dump, and that the company is aware of this and anticipated this, maybe not on, quite on the scale at which it occurred, but the company did anticipate a pump and releasing news after announcing the dilution, in addition to not disclosing who the special investors that are getting these 21-cent shares are, is indicative of that. So some of you are probably wanting to ask or point out even, how would the company know that the shares would be pumped? And the answer to that is quite simple. It's called history. So most stocks that I see being pump and dumps are frequently targeted over and over, and it ends up just being a big cycle. And I'm sure a lot of you are familiar with, or probably have at the very least heard of, Tim Sykes and his student Tim Grittani. And regardless of what you may think of Tim Sykes and whether or not his trading method legitimately works, or whether it only works because of his influence, I don't think that anyone can deny that some of the things that he teaches are true. Specifically, what I am referring to is the tendency of these pump and dump stocks to be pumped over and over and over again. This is why he makes lists, and not just him, but a lot of swing traders and day traders of penny stocks create watch lists, which are based on previous runners. And these watch lists are essentially fundamental to these types of traders and these types of trades. So in conclusion, and I'm not saying that GNUS isn't a good company or that it isn't a good investment or doesn't have potential. What I am saying, though, is that at the current time, in my opinion, the shares are, number one, overvalued, and it is not a good time to open a new position right now. Number two, I am not happy with the way that the management team tends to manage the company, which is in a manner that does not appear to be consistent with creating value for retail investors. And number three, management has tendencies to manage in a way that most definitely contributes to share dilution. So with all that being said, I am currently going to sit on the sidelines and monitor the company until such a time when I feel that it may be profitable to enter. Okay, so I do thank you, ladies and gentlemen. I'm afraid that this wraps up today's video. All I ask of you is to give me some feedback in the comments below. I want to know your thoughts, opinions, not only about the content in this video, but anything, related. Are you holding the stock? Is it just a trade for you? Is it a long-term investment? I want to know all your thoughts. Additionally, if you enjoyed this video, please make sure to smash that thumbs up button. If you're not a subscriber, you need to ask yourself why, because I'm going to be giving you guys content that has a lot of value in it. So make sure you subscribe if you haven't already. And as always, ladies and gentlemen, I thank you for watching the video. And I will see you in the next video.